Hello, this is Jed Brewer with Study Groups and the Below the Line Club. It's very nice to have you on our webinar today. We're going to be talking about two balance sheet items, inventory and accounts receivable, which, at least in the current asset side and the balance sheet as a whole for our types of companies, are very important items to be able to manage and discuss. So our webinar is titled Work Smarter, Not Harder, Fine-Tuning Inventory and Accounts Receivable to Maximize Revenue. And really pleased that we have two experts in their respective areas. On the inventory management side, first is Jeremie Davis, who's an executive partner at ahatis. And second, talking on the accounts receivable side, is Ann Pitts, who's president of the Pitts Group. Real briefly about Jeremie and ahatis. Jeremie and his partners each have over 25 years experience helping companies achieve improved business value through better planning and execution. They're considered at ahatis industry experts in sales planning, demand planning, supply and network planning, and financial planning. And they've used data and technologies to help companies across multiple industries, including this one, with different size companies. They love working with firms that are 15 warehouses or less. And Jeremie, as an individual, was recognized by IBM as a thought leader in sales planning and has received multiple IBM awards as well. So Jeremie's going to be talking a little bit about, as I mentioned, the inventory side and how do we segment customers to improve customer fill rates? How do we use segmentation to better predict future demand? How do we understand our one-time purchases? And in this rising interest rate environment, carrying inventory has a higher cost than what it used to have. So how do we best manage our working capital that we have? And that same theme of rising interest rates holds true to the accounts receivable side. The cost of having AR out there is more than it used to be. And Ann Pitts is going to be talking about 5 action items to ensure healthy accounts receivable. So when we get to her, she'll touch on systematizing your credit approval process, continual cycles of inefficient actions and processes and how they weigh down on the credit function, and what are some things out there that you can automate to make this thing more efficient and really improve your operations to make it an A-team. So that's a high-level overview of what we'll be talking about here today. We are going to record this and send you the recording afterwards, as well as the slide decks, along with our presenters' contact information. So I know they would welcome any individual questions that you have. But if there's anything that piques your interest as we're going through, we do want this to be as educational as possible and encourage you to submit questions to us. I have you muted, so please type those into the GoToWebinar dialog box and then send those over to me. I can read them and I will relay them to Jeremie and Ann as we move through. So with that introduction, let's go ahead and jump on in. Jeremie at ahatis, please step through inventory and how we can use segmentation to better improve our businesses.
You got it. Thanks for the introduction, Jed, and thanks for the time today. You know what we're going to try to do today is really give you some actionable thoughts that you'll be able to implement, hopefully right away, just in terms of how do we use segmentation to better manage, better run our business itself. So really two things that we're going to talk about, kind of an overview of what segmentation is, what it's historically been, and then kind of at ahatis, how we're looking at segmentation a little differently now. We've got a lot more data, we've got more processing power. We can do a lot more with the data that we have to really help move that ball forward. And then we'll talk about 3 to 5 areas in which we've seen and been with customers to really help them improve their overall business value by using advanced segmentation. But kind of just to start, just to kind of take a step back, why and when did we start segmenting our business? And everybody's seen it. What are your A items? What are your B items? And what are your C items? And it's been around in business for well over 100 years. So it's not a new concept. And it was really put in place to help with efficiencies. let's spend the time on the items that are driving the most value. And we've all heard the 80-20 rule that, hey, 20% of your items or 20% of your customers represent 80% of your revenue or 80% of your value. And like all of that's true. But what's changed in the last, I would say, not 100 years, but what's changed in the last 10 years is just that the data that's available to us, the processing that's available to us, and just the solutions that are out there. And when we think about how we did things traditionally when it came to segmentation, and I'm sure you've all been there, you know, a lot of times somebody within finance will take all of the items that we sell and they'll force rank them in descending order, either based upon units sold, based upon gross revenue, maybe even based upon profitability. And then we end up drawing lines and saying, okay, hey, you know, these are your top 20 performers, so you need to be spending your emphasis and time on that. This is your next group, your B group, and then your C group. And that's good, but at the end of the day, it's not necessarily great. How we're thinking about segmentation now is really going ahead and looking at it across multiple dimensions, not just looking at what is the volume associated with something, but also looking at what's the predictability of that order. If that's an item that the customer buys every 4 to 6 weeks, is there really a good excuse that we have to be out of inventory? If they're ordering something every 4 to 6 weeks, over 6 months, 12 months, so forth, those are items that we really should have in inventory for them. We're also looking at order size. You know, how normal is the order size, the order frequency, and then the other one is what's the worth and the value to the customer. And we've all seen it. You know, we want to own the lube room, and it's easy to get some of the top items just based upon price themselves. But to really provide value to that end customer, being able to have the bottom 3 items, that way they know when they call and they place an order for 8 items, hey, the top 5 are the easy ones because they've got good velocity on those items. But a lot of times you win that business, you win all 8 items because your ability to fulfill their needs on the bottom 3 items. So our perspective is it's not just one dimension that you should look at regarding how you segment your items. There's actually multiple factors that you should look at in terms of the predictability of the order patterns, the worth to the customer, the typical frequency, but then also being able to take out things like the one-time purchases and thinking about things like the new items a little differently. So kind of in summary, the traditional approach was good, not great. It was typically one-dimensional. Our methodology that we go to with customers is segmentation is still really, really important, but you get much more business benefit out of it when you look at it across multiple dimensions to truly understand, you know, what are the items that we should be spending the most time on, and what are the items that in total have the most business benefit to the organization itself. So that's a little bit about, you know, kind of the traditional approach, and then kind of a newer, more modern approach. And what we've seen is when companies go with a more modern approach, you really solve a couple problems. And one of those main problems is just improved sales forecasting. You know, really getting the sales teams to focus on the things that maybe we don't know the right answer on. And we'll get into each of these a little more. But one of the big benefits that we see with the segmentation is the improved sales forecasting, which that by itself leads into higher customer fill rates. So on time, in full, improving without bloating our working capital is something that we all really want to be a part of. And then just being able to segment things to where you truly understand what are these one-time orders, and really looking at new items and then the one-time planning differently than what we've done in the past. You know, if you've got a customer that does a big order every 18 to 22 weeks, what we don't want to do is have everybody get excited the week after they place that order, thinking that that's a uptick in the business. It's not really an uptick in the business. It's just that they've just placed one of their one-time orders. So really understanding what that is and being able to account for that differently than a lot of the repeatable orders that we have. And then also really being able to use the segmentation to look at our working capital different. You know, being able to understand, hey, you know, on our highly predictable items, how many weeks of inventory should we have on those? On our grouping items, how many weeks of inventory there, etc. Really kind of a unique way to look at working capital and really set different benchmarks in terms of weeks of inventory that we want based upon each of the segments of items that we've got out there. And this is one, when we get to that section, I think for a lot of the marketers out there, this is something that I think can be put into place with relatively low effort. And then I also want to kind of touch on just ERP integration, whether you're using PDI, NetSuite, whatever system that you may be using. Just the reality of integrating data between systems is significantly easier. And I think that the sooner we know about significant trends and changes in our business, the better off that we are. So we're a big advocate of, hey, if we've got all of the data, let's make sure that we're really leveraging it and putting it together. So those are kind of the, call it the 5 benefits that we see. And I'm going to go just a little deeper in each of them. You know, as we're doing segmentation, there's the items that are out there that are predictable in terms of their ordering frequency. We know that we've got certain customers, they may order every week, every 2 to 3 weeks. The order quantity is about the same. And those are the items that are relatively easy to plan for. Those are the items that as we categorize things, we kind of put them in their own bucket, because what we end up finding is the only thing people can do is kind of make it more difficult than what it needs to be. So when it comes to the predictable business and then even the one-time business, a lot of that, just let the math be what it's going to be. With your predictable business, you know that you're going to get those orders, you're going to get that quantity. Yes, there may be seasonality associated with it, but you can take that seasonality into play. So for those categories of items, just let the math be what it's going to be. And then when it comes to your sales teams, you know, when you look at a category B item, you don't necessarily have the predictability. It may be the customer buys it every 2 weeks, all the way up to every 4 months. But when you take a lot of those unpredictable customer item combinations and bring them together, you then can get a level of predictability. So it's that B group, which is what we really consider a grouping, and that grouping together gives you that level of predictability. The group business and then the new business, this is really the areas where we find the sales team, the operations teams, the planners, if they're spending the majority of their time in these areas, we end up seeing the best business results. Because the reality is, the predictable business, you can kind of let the numbers just speak for themselves. And then the one-time business, which we'll talk a little more about in a few minutes, that's something that we can also account for with a lot of the technologies out there. But I would say that the number one reason to get into kind of this advanced segmentation is that way we can have the sales teams, the operations teams, have them really focus on the segments of items and customers that really involve the most human interaction, and where you've got predictability in your business, just let the numbers speak for themselves.
Jeremie, can you talk just a little bit more about that group business category? I think I understand the new business, the one-time business, the predictable business, but just give me a bit better sense of that.
Yeah, so what you're doing with the grouping is these are the customers. When you look across an item, there may be 10 to 15 customers that purchase that item, but you may have 7 or 8 of those customers that you can't really ever tell when are they going to order again. You know, it feels like if you look at their order history over 6 to 18 months, sometimes they order every 3 weeks, sometimes there's 10 weeks in between orders. That could be because of any type of special pricing that you're putting in the market. It could be because jobs they've won or they lost. But it's when you go back and you're looking at individual customers and you're not really able to figure out the rhyme or reason of, you know, if they're always ordering 150 gallons, why is it sometimes there's 3 weeks in between their orders and other times there's 13 weeks between their orders? So what you do is on those unpredictable customers, you group them together into a single bucket in order to give you more predictability. So by themselves, you can't really see what they're going to do, but when you bring enough of them together, now you can start predicting what the volume's going to be. You may not know who it's going to go to, and that's okay. You just know that somebody within that group is going to have that demand over the next week or two.
That makes a lot of sense to me from an economist statistical perspective. Yeah, thank you.
Yep. And you know, the next one, when we look at fill rates, you know, as we've worked with a lot of different distributors and manufacturers across all parts of the US, you know, we generally find about 5 reasons why your customer fill rates aren't as high as what you would want them to be. And number one is your ability to get that product from the manufacturer. You know, that is the number one problem. But what I will say is the best thing that you can do, and we've worked with a couple distributors on this, is become more predictable to the manufacturer. Because if you're also in that situation where you're dealing with one of the manufacturers and you look at an item over the last 18 months and you find that you have no predictability, it's hard for them to also predict you. So the more predictable you can become to the manufacturer, the easier it's going to be for that manufacturer to go ahead and fulfill your individual purchase orders itself. So that problem will never go away, but just keep in mind, the more predictable that you can become to the supplier, the higher your incoming fill rates from them are going to be. And if we can improve our fill rates with the suppliers, then in turn we'll be able to improve our on-time in full with our individual customers themselves. And then there's also just the unpredictability of the items, the unpredictability of the customers themselves. And this is where the segmentation really proves itself to be valuable, which is, hey, let's create a segment of the predictable aspects of our business, and then let's create a segment of the unpredictable aspects of our business and plan those separately, because we know that there's going to be more art when it comes to the unpredictable business, and we can really rely more on the science when it comes to the predictable side of things. You know, the other big thing that we see that hurts companies when it comes to fill rates is, in your ERP, you may have a min and a max in there, but that min and max, maybe it gets updated once a year. Some companies, you know, we've seen them updated a couple times a year. Kind of our perspective is, with the availability that we have to data, there's no reason that can't be updated weekly. That way you can truly see where you've got changes in the business. And then I'd say the kind of the last one that we end up seeing is just making sure that the customers are buying in the right format. You know, if their volume warrants a tote, let's keep them in totes and out of 55-gallon drums or lower. But these are just kind of, you know, kind of the 5 areas that we see within fill rates, and then, you know, kind of an idea of how segmentation can help you with that. The one that I want to talk about next are these one-time orders, and this is probably one of the biggest things. A one-time order doesn't mean it's just once. It means that it's every 13 weeks or more. And one of the things with segmentation, as we identify a customer item combination as one time, that, hey, it's going to be 13 weeks or more, just flag it as that. That way it becomes its own bucket, because the worst thing that you can ever do is have a customer that buys every 16 weeks. They just place that big order, and now next week, demand planning thinks that they need to bring in the inventory because volume's on the rise. Volume isn't on the rise. It's just that it's now time for that customer to place that order. Maybe it's a business that has a start of season. You know, maybe it's a new project that they took on, or maybe from their perspective, they only do the replenishment of their warehouses, of their lube rooms a couple times a year. But here, the key takeaway is those one-time, when it comes to the one-time orders, your averages are likely always wrong. Identify that customer item as a one-time occurrence, have them be in their own segment, and then don't look at it right away. If you know it's going to be every 13 weeks, bring it back onto the radar after week 9 or 10. Benchmark the working capital. Like once you've done the segmentation of the predictable business, the group business, the one-time business, it's okay to establish your mins and maxes or your weeks of inventory based upon the category itself. Don't feel like every item in the warehouse needs to have the same number of turns. And also on some of these items, it may be an A item for an A customer, but they may be the only one buying it. It's okay to go ahead and just ask for customer protection to say, hey, I'll bring in 2 weeks of inventory, but you've got to commit to me that over time you're going to go ahead and take that. But I think the key takeaway here is don't be afraid to have different weeks of inventory thresholds based upon the segment itself. And then also know what are your best gap fillers when you're trying to achieve a minimum order quantity. What are the items that you always know you're going to be safe on if you need to bring in an extra more inventory in order to go ahead and fill a truck? ERP, this is, you know, ERPs can be updated a lot more frequently than what we see within the industry itself. So I know a lot of times the technology folks, you know, you may be getting comments that, hey, you know, our version of PDI, it's 10 years old, blah, blah, blah. It's hard to update, but there's tools that are out there, whether it's a bolt-on top of the ERP, whether it's integration in, whether it's a third-party solution, that really getting the ERP integration closer is something that's going to drive a lot of value, because you don't want to be sitting with static min and max levels on your inventory. You really want that to be to the point where those mins and maxes, they're dynamic, potentially updated weekly, at a minimum updated monthly. That way you've got a better view to your business in terms of what's really going on with it. So those are kind of the five the 5 benefits that we see from sales forecasting to improved on time in full to working capital and et cetera, by just thinking about segmentation against multiple dimensions compared to thinking about it how we've done it in the past against typically a single dimension, such as volumes or gross sales. So just want to really thank you for the time. We'll definitely reach out to you guys. We can demo the sell-through analytics solution that we have, or just go further in today's topics on, how can you get that more advanced customer and item segmentation in place.
A couple quick questions for you, Jeremie. Thank you so much for the valuable information. One is, where do you start? Like, hey, I see opportunity. What's the lowest hanging fruit or easiest place to start?
I think the easiest place to start is just looking at your sales history over the last, call it 12 months. The biggest mistake that we see is people don't combine the dimension of customer and item. Like, combine those things together. You know who your A customers are. Make sure that the items that these guys are going to carry, that they're going to order, regardless of the volume, make sure that your A customers are taken care of across all of their items. And that can simply be done by just doing a detailed sales history report, all items, all customers over the last 12 months, and make sure that you're taking care of your top customers. I think that's usually the best starting point itself. And then start looking at just what the order frequency is. How often are customers placing orders? What's the average order size? The next bucket to look at are, what are the things that the math can just solve the problem on? So it's a little deeper look at the data, but the things where you've got high predictability, kind of put those off to the side and let the system just do the work when it comes to the A items, because you've got a certain level of predictability. So that's an area that you don't necessarily have to spend a tremendous amount of time in.
Thank you, Jeremie. And the customer asked a clarification question, which I think is a good one. How are you classifying your A, B, C, and D items? Like, I'm thinking, you said, hey, let's segment customers, and A customer is probably the one who brings you the most gross profit dollar. But what are your A, B, C, and D items? How do you classify those?
You got it. It can really be done. It can really be done the same way, and it's okay to also do it at the intersection. You know that, hey, this is an A item for these customers. It may be a B item for these customers, and that's really where kind of that, I'm going to go back to the building block slide, comes into play. That when it comes to your items itself, that's really a combination of, hey, how much of the expected demand is coming from predictable business, group business, one-time business, and then new business. I mean, customers is easier, A, B, C. Items a lot of times is really the combination. And in in item, it's okay if it goes across multiple buckets itself. It's just really being able to understand what are the building blocks that make up that item itself. So now when you look at an item, you can say, okay, it's telling me my demand next week or next month is going to be 200, but I can see that 120 of that comes from the A segment. I can see that 40 of that comes from the B segment, and I can see that the remaining comes from the one time itself. So item is really the building block across the predictable business, the group business, and then the one-time business.
Well, good stuff, Jeremie. Thank you so much for your time here today. And of course, for the audience, we'll send out Jeremie's contact if you have more questions for him as well. Let's go ahead and change gears for the moment, and we'll start talking about accounts receivable and turn to Ann Pitts, who's the president of the Pitts Group. And the Pitts Group provides AR and collections, the whole credit process, consulting to people like our study group members. And Ann's also a study group facilitator of ours and does a really a great job and provides fabulous industry education in her area of expertise. So Ann's going to be talking a little bit about how do we improve that credit function, how do we systematize our credit approval process, how do we keep an eye on customer growth and associated credit limits, what do we automate, which is all very important in this higher interest rate environment that we're in. And even without that, it's always important just as a general course of business, because cash in the bank is what keeps our business going at the end of the day. So Ann, let me turn the floor over to you.
Thank you, Jed. You said that very well. And yes, cash in the bank is what it's about. It's, really and truly, it's the lifeblood of your company, your AR. It's like a living, breathing entity. I work with, petroleum companies. I've been doing this now for 10 years, very specifically in this particular area. And I consistently see issues from one company to the next that are very common. And so I kind of group some of these things together in this talk, and I'm going to give you 5 important things that will really help you manage your own accounts receivable lifeblood. And the things that I'm going to talk about are going to be, guys, totally within your control. It's things you can do in your business. Just have to have a game plan. So as you guys know, this petroleum company industry is so focused on high growth and getting gallons out the door, which is wonderful. On the flip side, though, you also have to watch customer credit risk and make sure you get paid during that growth. That's really important. So, as a banker making loans, I worked with a lot of different industries, and petroleum's different. It really is. And I look at it, I call it the perfect storm when it comes to accounts receivable, because you have very high growth business models. You have very low margins. You've really got to push a lot of gallons out. And you have very entrepreneurial leadership that are focused on expanding, maybe even into totally foreign segments of the industry. I know sometimes y'all must sit there and think, boy, it would be nice to be a furniture manufacturer putting together couches all day long with a 200% markup, on the cost of product, because that's just not the world you live in. But anyway, so I always recommend to control the cash flow exposure brought on by high growth and low margins. You really need to put a laser focus on the order to pay process. And this focus has to start at the top, flow down. I see some really, really good employees, including credit department folks, that operate on their own little island without probably enough guidance from leadership with that laser focus. Now, I'm not suggesting micromanagement at all, but there does need to be a culture of solid procedures in place that are understood by everyone, from the salespeople to the customer service to the credit department. And, recreating that wheel every day on what gets released, who gets turned down, who gets a collection effort, that's just not an efficient way to operate. So, put those systems in place, let employees follow the game plan, and then manage the exceptions as they inevitably will come along. But I also want to mention that don't forget, guys, this is a partnership between you and your customer. You guys jump through hoops to facilitate and deliver what your customers need. And, you give them, it's part of what Jeremie just talked about. You have to anticipate, what their needs are going to be. You want to give them excellent delivery, excellent service. What do you expect back from them? There's not a whole lot, but the top of the list should be that they pay you, that they pay your invoices on time. And I hear, we sit and talk in meetings about what's a good customer and a bad customer. Well, a really good customer is somebody that does order a lot of product from you, but if they don't pay you on time, are they a good customer? There are some salespeople that would say absolutely they are, but I'm going to challenge that when you talk about what you make off of the deal, off of the transaction. So Jed has talked about it, and I'm just going to underline it. There are recent changes in market conditions, including the cost of money right now. I don't know if you've noticed yet, but it's becoming increasingly more obvious that the banking landscape is changing a bit. Banks are guarding their capital. They're pulling back on their lending requirements at the moment. I heard it compared to a turtle pulling his head in the shell. We're kind of going through some of that right now. And the cash flow trend is something your bankers pay attention to when they're looking at your business too. So I want to just point out, this is a slide that's, a few years old, but it's still very applicable. And, this guy, this petroleum company had over 7 million in receivables. I'm sure a lot of you have a lot more than that, but he was diversified. He has a very diversified company. He was 86% current. That's a pretty good statistic right there. Not bad for a diversified jobber. And yet, his customers are still controlling over $1 million of his cash. And, with interest rates what they are right now, that's a free loan right there, over $1 million. And I'm going to throw this in here too. A lot of you, it's free money because you're not assessing the what I call the dreaded finance charge. And, have you considered calling it what it is? It's a late fee. It's triggered by late payments for people that are paying late. I would encourage you to charge people a late fee if they're paying you late. That just makes sense. So the things that I'm going to cover, Jed went through it at the beginning, but these are the 5 things that are within your control. So let's just get started on it. I promised an effective tool to improve efficiency. If you look at the root cause of inefficiencies, it's because a lot of the times employees are not aware of how inefficient things are that they're doing. The process is very normal to them. They don't see it as a problem because they've always done it that way. If you want people to do something different, you need to clearly communicate what they need to do and give them the why is always a good idea too. And then of course, check back to make sure the behavior has changed. So I'm suggesting you guys need a company-wide game plan credit policy. It is a clearly crafted, detailed, step-by-step description of how that department, the credit department, will be handling processes from the receipt of new customer application all the way through to collection at the very end. And it's a terrific way to put people on the same page. Employees are able to see a written word on how the different moving pieces and parts should work. And then when things go off the rails, as they will do from time to time, you're just managing those exceptions. I'm sure you guys know publicly traded companies are required to have a written credit policy, and there's a good reason for that. And when I talk about a credit policy, and this is something I do, I write credit policies, so I'm very familiar with what they look like. We're not talking 3 pages here via like mission statement type terminology. This is detailed, I'd say a minimum of 10 pages, taking into consideration all the major activities that are going on in the building when it comes to order to cash. I just ran through some little suggestions right here. But so a credit policy, it is a document that should be shared company-wide. It is a document that should reflect what's going on today, not what should be going on in the future. In other words, when you talk about goals for the accounts receivable aging in a credit policy, you don't put best case, you put what's going on in the building right now. So it should be real time. It should be reviewed at least every couple of years. It should clearly state the standard operating procedures that sales, credit, dispatch, customer service, everyone should strive to stay in compliance. What it is not, and I want to throw this in because I get asked this a lot, it is not a public document. It's not something that anybody other than your own employees read or really quote. Nobody wants to be told, well, that's against our policy. There's other ways to describe things that you need to educate your customers about. So I recommend that. Number 2.
And real quick question, how important is credit bureau reporting?
I think it's extremely important, Jed, and the reason for that, it's not always, as you guys know, 100% reliable at all, but you have precious little information at your disposal to make a decision about credit risk. And if you can take credit reporting information and give you a historical snapshot of how that customer handles his business, that's what you have in your future to look forward to. And you have a lot of customers that have the ability to pay you, but they don't have the desire to pay you. That will show up in a credit report. That's how they manage their receivables. So is that a good enough answer? It's really important. So systematizing that credit approval process. And this is going to figure into this, Jed. This goes a long way to help your sales staff understand why their new customer is being questioned or even being denied as not being creditworthy. That can be a mystery to your hardworking salespeople, and it shouldn't be. It should be very clear to them. So what I recommend to systematize the credit process is a credit scorecard. It takes the emotion out of the credit decision, and it clearly states, I'm going to go back, Jeremie used A, B, C, D. I'm going to use it in a different connotation. This is customer rating A, B, C, D based on this scoring. And, you know, I'm not suggesting here that you only bring on A or B customers. That's not the purpose of a credit scorecard, but it is to know what the risk factor is if you're looking, especially at a brand new customer who's in the D category. How are we going to handle that kind of potential new business? And I'm just going to tell you, a well put together credit scorecard, I'm going to show you a picture in a minute, but it can be completed in less than 4 minutes. I do it myself all the time when I'm doing training. Doesn't take a long time. It includes that credit department, that credit bureau information Jeb just asked about. So, you know, the scorecard, it takes information, but it also can be pumped up with things. You can get a higher score when you add on things like that take away some of the risk, like signing a personal guarantee, signing up for electronic payment, offering some sort of collateral. And this is exactly what banks do when they're looking at extending credit. They are measuring risk and trying to put together ways for it to be mitigated. So here's a picture of a scorecard. It's a bad picture, I realize that, but it's just a spreadsheet. And it takes things that go on in your credit manager's head, measuring risk. How many years has this customer been in business? You know, running the credit report, inputting those scores. Have we done business with them before? Is this a risky business segment? Is this, can I get a bank reference from them? What does that reference look like? You put that information into a spreadsheet with assigned weighting that, you know, give those numbers some meaning. You hit enter and boom, you have got an A, B, C, or D measurement. And I'm gonna mention this too, and it is a invaluable tool that can be processed by an admin person. Does not have to be your credit manager, does not have to be your sales manager. Someone that is in an assisting capacity can fill this out, then pass along completed to the credit manager for evaluation of approval. And it also is a tool for setting a credit limit. And because you have assigned, you know, an A customer, we're fine with up to a $75,000 credit limit without any further looking. And I use that number just pulled it out of air. You know, a B customer, we're good with him having up to a $50,000 credit limit, whatever those numbers are, and they're different from company to company. A final thought on this scorecard that I think is extremely important, it helps customers get from a no to a yes on credit approval. This is something your salespeople really like. They hate to be told no. So what if they're told, we're getting a low matrix score here on your customer, but if you could ask that customer to sign up for EFT or to sign up for a personal guarantee, you know, that's going to add points to his score, and we might could get to a place that's an acceptable range for that credit limit that you're requesting for him. It's a way to get to the yes. All right, move on. Number 3, keeping an eye on customer growth. And I want to ask you guys if you've ever had this happen before, and I already know the answer is yes, but I'm going to ask anyway. You got a 20-year customer who's grown a lot. It's been a good customer, somebody good in the community. They've experienced some business disruption, cash flow disruption, banker maybe's gotten tight on them, and all of a sudden they're not paying their invoices on time. And because of that long history, no one in your building gets too disturbed until they look up and they see that customer owes you over $1 million, is past due. And by the way, their credit limit was set at $25,000 10 years ago. You know, that's a shocker, and it happens. And I'm seeing and hearing of it happening more and more often. It's just a tougher environment we're in right now. So, you know, my advice is to keep a watchful eye on customers whose credit limit is set too low or going over their credit limits, because people are releasing loads because that's a good customer, you know, that's somebody they know well. Or maybe the customer is setting off red flags that indicate, you know, a lot of stress. So you've got to know the credit review triggers, and then I'm going to talk to you a minute about what a credit review looks like. So these are just some examples of common triggers that allow you to know that a customer is, you know, probably needing to be looked at. And these are some of the semi-annual timing, that sort of thing that you might develop a process for. Now, to create a credit review system, you go right back to that matrix and you run a new credit report. You fill out a matrix score, and if you've been using the matrix, you do it side by side where you see the trend to an initial one. You can see what's happening with that customer. You pay attention to recent payment trends. You benchmark the credit reports, you know, the old one to the new one. You review the 12-month rolling order and payment history, kind of see what's going on with that. You check to see if they've signed a personal guarantee. You're probably not going to get one after you establish the original relationship. That's why it's really important to push for it if needed when you first bring them on as a new customer. You know, anything negative, you're looking at all this stuff, you're reviewing it, and you can use that matrix to do that too. So once you get this information, you've got your, you know, your benchmarking, you're looking at the customer trend, you're looking at what they owe you, you've got all that information together. You know, what do you do next? You actually sit down and talk to the customer. And for some reason, this seems to be kind of a difficult step. And I'm not talking about, a lot of times if it's this $1 million guy, I'm not talking about the credit manager talking to the customer. I'm talking about somebody at a much higher level. It could be your CFO. It could be even an owner having a conversation, and you work out a solution with them. So, you know, what that solution looks like can be a lot of different things, but until you have that conversation, you're not going to get there. So I'm going to tell you something really important here, guys. I'm calling this proactive credit management. When you talk about credit review and going back and looking at people that are throwing off red flags, there will never be enough time in your credit manager's day to perform periodic credit review. There just isn't. That task has to be scheduled based on need and for whatever the reasons are, but you're going to have to schedule that time in because they don't have time to do it just in a normal day. And I'm also going to suggest that administrative help can be brought in to do a lot of this information gathering, and then the credit review falls to the credit manager. That's really proactive credit management. Okay, number 4, tasks to automate. Now this one blends in with what I just talked about, proactive versus reactive. And, you know, credit managers are up to their necks in administrative stuff, sorting out billing, working through credit holds. I literally saw a company not long ago that had a credit hold go on accounts that had a credit on their AR aging, would issue a credit hold. That kind of thing is just busy work, and it shouldn't happen. I hope it's not happening in anybody that's listening to this webinar. So, you know, credit people talking to salespeople. So to automate whatever you can automate, any repetitive task, an example of a fantastic automation is that first touch on a past due customer. At 5 days, 10 days, I don't know what the first touch is in your building, but that first touch is a friendly, gentle reminder. It can be a simple email that taps your customer on the shoulder and reminds them of a past due invoice. This automation frees your credit manager up to put time and energy into the folks that have ignored that reminder and need a heavier touch. And just about all back office software systems offer some sort of dunning feature. Quite honestly, do I see a lot of companies taking advantage of this dunning feature? Nope, not a lot. but the ones that are using it will tell you that it can be a game changer, that it works really, really well. So another task to automate, and automated payment is just so important. Our world is obviously moving in the direction of automation. So, and I'm going to say, people resist moving from, I've been doing business with you for 15 years, now you want me to pay electronically. That's a different conversation. A lot of them will still do it. But the new customers, sell it to the new customers. This is your choice. How would you like to do business with us on payment? I know some jobbers put an incentive in place for customers that want to come over to their Easy Pay plan or sign up for their Easy Pay plan, giving them some price incentives for, a period of 60 days. But, giving customers a choice on automation where they're not having to put a check in the mail solves so many problems like invoice confusion, lost payments, drivers being asked to carry money, late fees. It is hugely customer friendly when you can get a customer on board. And there's just no better time than now to sell payment automation, and especially in the beginning of the relationship. I want to point out too, something you don't see on this slide, you do not see credit card payment. I'm really, really getting soured about that for a lot of reasons, including the announcement that came out yesterday that MasterCard and Visa are increasing their credit card processing fees. I think $40-something billion that they receive in revenue for processing fees. That's not enough, and they're increasing. And a lot of you guys are not passing that on to your customers, so it is eroding your margin. So when you talk to people about paying you, just leave it out. And there'll be some people that you'll have to, or they'll be the only way you get any money out of them. But in the beginning, there's just, this is the offering that needs to be out there. Okay, so number 5 on tasks to automate, I think I've got my numbers wrong. No, number 4, tasks to automate, excuse me, is what does your leadership really want to see to keep these surprises from happening? They never want to see a surprise, right? So there should be a few push to leadership on a weekly basis. And people ask me all the time, what kind of KPIs are the most meaningful? What should people want to see? Well, I can throw out a lot of good, examples, percent over 60 days, DSO, collection effectiveness ratio, bad debt to sales, year-to-date trends. But honestly, why don't you just ask? Because your leaders know what they want to see. And they might be looking at something that would be surprising to you or your credit manager. So I suggest asking and seeing, what do they want to see? And that's where you go with that one. All right, number 5, exercise superior collection. That is really going to guard your cash flow, and it helps train your customers that you are a company that expects to be paid. So I like to compare this. Do you guys remember when you were a kid, the Chinese water torture? It's slow, it's steady, it's increasing intensity, that dripping. So if collection efforts are like the Chinese water torture, that's really what you want to try to do. If your collection efforts are sporadic or sparse, customers really don't think you care when that receivable is paid, and they will end up paying the ones that make the most noise or it's most beneficial to the customer. And in today's cost of money so high, your customers are managing and will continue to be managing their payables closer than ever. So if you have your credit manager and staff so busy putting out fires, doing the millions of administrative tasks, this number one thing that will be pushed off and not done in a timely manner is collections. You know why? Because no one is waiting for that credit person to make a call to them. So it becomes a secondary priority, while the AR aging and accountability for that is really the number one priority. So collecting for anyone, credit analyst, collection specialist, credit manager, it also takes a laser focus. You have to stop what you're doing. You have to block time. They might need more time in their day for collecting. And I recommend always touching customers early and frequently. Early in the morning is the best time to start those collection efforts to block that time. you really need to develop very systematic strategies on who to call, when to call, what the priority is. And, you know, this is, to me, it's a good roadmap. Broken promises at the number one, I'm going to make that call first. Who didn't do what they said they were going to do? That's a phone call right there. That's not an email. That's a phone call. Accounts on credit hold, that's kind of a no-brainer too. That hold is being, you know, is on that load, and is there a valid reason? Does the customer even know it, how to fix it? And then the highest dollar past due accounts, those are also at a high priority for sure. I do not recommend you focus on particular buckets for collecting. There's, you know, I've heard people tell me, well, I'm really on that 120-day bucket. Well, guess what? That 120-day bucket's probably already a lost cause or going in that direction. Why don't you get further on that 30 and 60-day so it doesn't become the 120-day? Now, I do believe you should know everything you could possibly know about the people in the 120-day, but that focus needs to be very much on the buckets to the left, which are the earlier guys. Those are the ones that have a better chance of getting you paid. A team collectors, they know how to negotiate. They're good negotiators. They know ahead of time before they get on the call what they will and won't accept. They should be authorized to negotiate while they're on the call. And here's the thing, if that dollar limit is over their authority to negotiate, they don't need to be the one making the call. Somebody else needs to be making the call. These are just some things that, you know, people can negotiate, some good negotiating tips. You know, you get creative. There's more than one way to skin that cat. Help people with get to a place where they can send you some money. Escalation plan. This is super important too, guys. If your credit or collections person is getting totally ignored, emails, phone calls, whatever they're doing, they're beating their head against the wall with no results. The customer's showing they're obviously not afraid of the activity. So how do you guys change it up? You have to have an internal escalation plan. The higher level of authority that's going to get involved, not the salesperson. They're the relationship person, not the credit person. They've already been ignored. It needs to be somebody in your building that can have that conversation, that can make an office visit, that can get on the phone. If that doesn't work, then the escalation goes to the third party. It's what I recommend, which is a collection agency, or bringing an attorney, you know, to do what they do. So, yeah, protect your lifeblood. I hope you guys found these 5 little tips, something that you think you could take the ball and run with. And Jed, that's just about what I've got.
Thank you, Ann, so much. I really appreciate all the tips and tricks within here. Great educational content. Real quick question for you in the last minute or so. But how could you potentially help a company if they want to really improve their credit processes?
Well, anybody that wanted to improve their credit processes the best thing would be just to shoot me an email or give me a call. I have questions that I go through and ask. I can give you some, you know, some advice on some things to seek out as far as, you know, solutions. An example would be, I can't tell you how many people say, am I overstaffed or understaffed? That's a big deal. And, you know, I'd have to get into the company, you know, a little bit more with individual questions, but I'm happy to do that just to have a conversation, and anything that I can throw out there for help, I'm always happy to do that too.
Well, thank you so much, Ann. And again, if anybody has questions, feel free to shoot those over. I'm going to send the copy of the presentation out to everybody afterwards, so you have as a reference, as well as the recording on this. So thank you for your time. I hope you found both the inventory side and the AR side to be timely and educational. Look forward to talking to you next time. Goodbye.